Economic immunity describes a financial structure's capacity to endure and thrive during economic stress. It emphasizes resilience, allowing systems to withstand adverse conditions rather than merely survive them. The concept also incorporates anti-fragility, meaning the system improves or strengthens under stress. This approach prioritizes stability and robustness over simple, continuous growth metrics. Ultimately, economic immunity signifies that true mastery lies in preventing collapse and adapting effectively. The illusion of stability describes a false sense of security in favorable conditions. It often arises when markets are consistently rising, leading investors to perceive safety. Similarly, businesses may feel strong and secure due to growing revenues. This perception masks underlying vulnerabilities and potential risks within the system. Favorable conditions can obscure weaknesses that might become critical during downturns. True financial strength is only revealed and tested during periods of economic contraction. This occurs when liquidity disappears from the market. Credit availability tightens significantly, impacting businesses and consumers. Consumer demand also slows down drastically, further challenging economic stability. Economic immunity refers to a nation's resilience against financial crises and downturns. Building this immunity requires proactive measures implemented well before any crisis emerges. These preventative strategies strengthen the economic framework in anticipation of future shocks. It cannot be effectively established reactively once a crisis is already underway. Attempting to build immunity during a crisis is often too late, as conditions have already deteriorated. An anti-fragile capital structure is designed to thrive under adverse conditions. It gains strength and improves its position when subjected to pressure and stress. This concept contrasts with fragile wealth, which deteriorates or breaks under stress. It also differs from stable wealth, which merely endures or survives challenges. An anti-fragile structure actively benefits from volatility and disorder. Such a structure is resilient and adaptive, enhancing its capabilities through external shocks. Strong liquidity buffers are crucial for an anti-fragile capital structure. These buffers consist of readily available funds. They are designed to cover financial obligations. They also enable seizing opportunities during market illiquidity. Such buffers ensure stability and flexibility in challenging economic conditions. Low emotional leverage is a critical concept for maintaining financial discipline. It emphasizes making financial decisions based on predefined rules and objective analysis. This approach prevents succumbing to impulsive reactions driven by market sentiment. It specifically guards against decisions influenced by emotions like fear or greed. By minimizing emotional impact, investors can adhere to long-term strategies. This fosters a more rational and consistent approach to wealth management. Diversified income streams are crucial for enhancing financial stability and resilience. This strategy involves generating revenue from multiple distinct sources. The primary benefit is a reduction in reliance on any single revenue stream. This approach contributes to anti-fragility, making a system stronger when exposed to shocks. If one income source is negatively impacted by economic shifts, others can compensate. This ensures the overall financial system remains sustainable and robust. Defensive asset allocation is an investment strategy focused on capital preservation. It involves distributing investments across various asset classes. These assets are chosen for their differing performance under various economic conditions. The primary goal is to protect capital, especially during market downturns. Flexible cost structures enable businesses and individuals to adapt expenses. This adaptability allows rapid adjustments in response to changing economic conditions. Such structures are crucial for maintaining financial health during economic downturns. They help preserve profitability when revenues decline or market conditions shift. Flexible costs also ensure solvency, preventing financial distress during contractions. This strategic financial management is vital for long-term business resilience. An anti-fragile capital structure aims to thrive amidst economic uncertainty. Its primary goal is to ensure continuous survival through any economic turbulence or crisis. Beyond mere survival, it seeks to strategically benefit from market disruptions. This involves capitalizing on the chaos and dislocations that economic crises create. Thus, an anti-fragile structure is designed to strengthen and grow from volatility. In thriving economic periods, market discussions often prioritize business valuation metrics. Valuation based on future potential and market sentiment becomes a key focus for investors. However, economic downturns, such as recessions, shift this financial paradigm. During these challenging times, the emphasis moves from valuation to robust cash flow. Strong cash flow ensures a business's ability to cover operational costs and debt obligations. Ultimately, adequate cash flow becomes the primary determinant for survival for entities during recessions. Economic immunity emphasizes the importance of predictable recurring income for financial stability. This income stream provides a stable foundation, mitigating the impact of market volatility. It reduces an entity's reliance on speculative gains, fostering greater financial resilience. Prioritizing predictable income strengthens economic immunity against external market fluctuations. Essential sector exposure involves investing in industries that provide fundamental goods and services. These sectors are crucial for daily life, encompassing areas like utilities, healthcare, and consumer staples. Such investments are characterized by more stable demand for their products and services. This stability persists even during periods of economic downturn or recession. Therefore, essential sector exposure can offer a degree of resilience to investment portfolios. Economic immunity is strengthened by reducing reliance on speculative activities. Speculative investments are inherently volatile and highly sensitive to market fluctuations. Such investments can lead to rapid capital erosion, particularly during economic crises. Minimizing speculation helps stabilize financial foundations and protect assets. This approach fosters a more resilient economic environment, less prone to sudden downturns. Sustainable margins are crucial for a business's financial health and longevity. They represent the ability to maintain profitability even during periods of revenue decline. This financial buffer also safeguards against the impact of fluctuating operational costs. Such margins are critical for ensuring the long-term viability and resilience of an enterprise. They allow businesses to absorb economic shocks and continue operations effectively. Debt can serve as a powerful tool for accelerating growth and expanding opportunities. However, uncontrolled leverage poses significant risks to financial stability and resilience. Excessive debt can erode an entity's capacity to withstand economic shocks. Maintaining economic immunity requires a strategic approach to borrowing. This involves selective borrowing, where debt is acquired judiciously for specific, productive purposes. Strict adherence to disciplined rules is crucial for managing debt effectively and sustainably. A preference for fixed-rate debt offers stability in financial planning. It ensures predictable interest payments over the loan's duration. This choice shields the financial structure from sudden increases in borrowing costs. Such predictability is especially valuable during periods of market volatility. Maintaining manageable debt-to-income ratios is crucial for financial stability. This strategy prevents debt obligations from becoming overwhelming. It provides a buffer against reduced or interrupted income streams. This is especially vital during economic downturns, ensuring financial resilience. Economic immunity is a strategic approach to financial management. It involves decentralizing capital across various geographic regions. This strategy also extends to diversifying investments across different asset classes. The primary goal is to mitigate risk and enhance financial resilience. By spreading capital, a downturn in one area does not jeopardize the entire financial position. This ensures greater stability and protection against localized economic shocks. True economic defense relies on strategic global positioning. This strategy involves diversifying investments across different regions. When one region faces an economic downturn, others may be expanding. This balance helps stabilize the overall portfolio's performance. Market performance often tests psychological resilience more than financial calculations. Emotional immunity involves adhering to predefined rules and ignoring external social noise. It requires respecting established risk limits to prevent impulsive decisions. Maintaining long-term conviction helps avoid panic-driven actions during market volatility. Liquidity represents readily available cash or assets that can be quickly converted to cash. In stable economic conditions, liquidity is often viewed as a financial buffer. However, during times of crisis, liquidity transforms into a powerful strategic advantage. When markets face distress, many entities are forced to sell assets at reduced prices. Organizations with ample liquidity can then act as buyers during these downturns. This enables them to acquire valuable assets at significantly discounted, distressed prices. Building economic immunity involves designing financial structures to withstand extreme adversity. This approach focuses on preparing for the worst-case scenario in financial planning. It anticipates simultaneous market downturns and significant income reductions. The design also accounts for periods of frozen opportunities and limited access to resources. The goal is to ensure the financial structure remains functional and resilient under severe stress. The seventh evolution signifies capital survival supremacy, moving beyond mere wealth building. It focuses on fortifying existing wealth rather than solely accumulating new assets. Key aspects include controlling risk and preserving liquidity to ensure financial stability. It also involves disciplining psychology to navigate economic cycles effectively. This approach aims to benefit from economic fluctuations, avoiding vulnerability to them.